Pow, what up, folks? It's your boy Joe. Yo, ignore that. I'm about to replace that joint, but yeah, it's a little broken right now. It's with thermostat. Anyway, yo, it's the first episode of Market Mayhem. Just want to give y'all some quick tips about investing. You see these stock tickers everywhere on every news outlet you can find. Nobody really understands what those numbers mean going across the bottom of the screen, how to invest their money, and things like that. So I want to start off, give you guys some basic definitions of these indexes, what they mean, what those numbers going across the screen mean, and maybe get into a little bit of how you can start to strategize and invest your money wisely. So, number one, what is a stock index? These indexes, like the New York Stock Exchange, Dow Jones, Nasdaq, the S&P 500, they are a collection of stocks, companies that they're tracking the prices of it day by day. So when you see a quote for the Dow Jones saying that they're up 100 points or 1%, that means on average the 30 stocks that Dow Jones chooses to follow, and yes, it's only 30 out of the thousands of companies that are possible, that's how much they moved on average. The price goes up when more people buy. The price goes down when more people sell. It's the basic supply and demand principle. So when you see these numbers every day, the stock index is really just a benchmark for them to show you on average what people are doing with their money. These indexes are not equally created. The Dow Jones is fairly representative of the economy in the U.S., but like I said, there's only a few companies, and these are usually the big time companies that are in the Dow Jones. Who picks the 30? There's a board that's responsible for that, but it might not be exactly what you need to invest your money. A very good index to look at is the S&P 500 because, like the number says, it has 500 companies that it looks at and gives you a better idea of how some of these companies are doing day by day. But of the big three, NASDAQ, S&P 500, and Dow Jones, they more or less mirror each other day by day. So that's a good thing. Also, there are indexes all around the world. You have the Nikkei in Japan, you have the Hang Seng in China, you have the FTSE in Britain, and a bunch of others. So if at any time you want to try to gauge how the market is going to perform on a given day, when you wake up in the morning, a lot of these other indexes are pretty much wrapping up their days. Look at how they're performing, and that'll give you an idea of what you can expect here in the homeland. Of course, with the Euro crisis, some of those other stock markets aren't doing as well as ours. I mean, you see volatility here, but they're kind of taking a nosedive. So keep an eye on that. The efficient markets like the U.S., they respond very quickly to news items. Basically, because of our access to the internet and to news outlets, as soon as you hear news, it affects stock prices. So that's something to think about. Also, you'll hear them talk about off-hours trading. People don't really know what that means, off-hours trading. Basically, people are betting on the market after the market closes. So you can bet that a company's stock will go up or down by a certain amount and put some money down on that while the market is closed, and the trade will be executed depending on how you set it out when the market opens again. So that's a lot riskier. There are ways to guard yourself against taking big losses in off-hours trading, but it is not for the novice investor. All right. So as far as picking stocks, there are a few strategies that you can use to pick good stocks. A lot of people, because they don't know about markets, they try to go after the big companies like Microsoft or Apple or Google or things of that nature. But what you'll find is that most of the big investors have bought these companies so much that you're not going to see much gain on these stocks. For instance, Microsoft, It had its big run of growth company-wise back in the 90s. Now, I mean, their sales are still ridiculous because they have such a stranglehold, a basic monopoly on the operating system game for businesses and governments. So they're going to always turn a profit, but their stock has been stagnant for probably close to 10 years now. Analysts always say that it's underweight, meaning that the stock is actually worth more than it's selling for, but it never goes up because too many people have stock in Microsoft and it's not going to go anywhere. So what you want to do is try to find smaller companies that are up and coming. Some that recently kind of blew up were, I don't know, Sun Microsystems, probably late 90s, early 2000s. Cisco Systems was huge. Which other ones do you have? A lot of parts makers for companies like Apple or for laptop makers or things of that nature. These companies that are components of supply chains are better investments for the average investor than these big companies that have been established for 50, 100 years because they're not going anywhere and they're very expensive. So next episode, what I'm going to do is I'm going to give you some strategies and how to figure what a stock price should be and compare that to what the stock price is. If the current stock price is less than what the stock price should be, that might be something that you want to invest in. So I'll have those formulas for you. I'm going to post it in the comment section as well, and I'll take your insights into what I can talk about next time. All right, so hopefully you understand a little better how market indexes work. We'll get into individual stock prices as well that you see in those tickers next time. All right, talk to y'all soon. Pow.